was down 606 points. Toronto was about 478. But my goodness, there's devastation around the world. I was looking at the indexes from just about everywhere. 634 in the States now as it's popping up on my screen. So these are huge days, and that's why we are very fortunate to have with us Greg WellDone, one of the top analysts in North America. This is a guy I always say that other analysts read to figure out what the heck's going on behind the numbers. I'll tell you where to find him in just a few minutes' time. But first off, Greg, I appreciate you taking the time with us. Let's start with today's market action. When do we categorize this as a crash?
Well, I mean, I think you pretty much can categorize it that way now. I mean, over the last 2 weeks, this market obviously has come off sharply, losing what would be considered a normal bear market amount, percentage terms, across the globe. I might say collapse, maybe crash, maybe we start to use that word tomorrow morning. I mean, I anticipate, it's just a setup. I mean, you can never, it's very difficult to handicap a market that has done what this has done. And I mean, this is, without sounding too verbose, I mean, this is pretty much what we expected when we spoke last in June. This scenario is exactly what we laid out, that the markets were going to have a real hard time dealing with the end of QE2, and I think that the situation in Europe, which we talked about at length, would become more serious when Italy got involved. That's exactly what's played out. You could see a scenario where the market gaps down tomorrow, has another big loss, and then starts to rally from there. Potentially maybe even an intraday reverse tomorrow, and that gives you some kind of semblance of a pivot point. But I think that, without seeing the Fed in the U.S. come in aggressively with QE3, and I think that's going to be problematic this quickly, you probably have lower to go over the medium term.
Let me just, again, the quantitative easing, basically we're talking, forgive me for oversimplifying it, Greg, but we're talking about the printing of money to goose the economy. It certainly hasn't worked so far, and as you say, the suggestion is more will come. I find that's one of the difficult things as an analyst to sort of make predictions, simply because they're not phoning me before they initiate these programs, and there's been some major moves that are done behind closed doors politically that they announce, and there's an instant reaction within the marketplace.
I think there's two interesting things to discuss on that, and I'll try and be as brief as I can. The first one is QE2 worked to the degree that it kept asset prices inflated or reflated. It didn't work to the degree that it also inflated commodity prices, which is part of the reason why the economies now are wobbling. So it's one of those unintended consequences. The second thing to think about is, sure, they could come out with the QE3, another round of debt monetization, running the printing presses to try and, quote unquote, save the stock markets here, primarily because that's the only area of wealth reflation that we've seen since 2007 when the crisis started, and I view this as kind of a relapse in that same crisis. But they haven't fixed anything. Quantitative easing does not fix the housing market, doesn't fix the labor market. So you still have these underlying problems that need to be dealt with. I think the fear would be if they came out and announced another round of quantitative easing and it failed to stem the selling. That would be a worst-case scenario. I don't envision that, but you got to keep that in mind. And I think that's something the Fed, they know they have. They don't have unlimited bullets here. And if they expend another round, you got to make sure that it's well timed, and so it's a tricky game, to say the least.
There's so many places I want to cover today. Let's start with the Standard & Poor's downgrade. It surprised me not that it happened. I was sort of predicting the third week of August, so when it was pushed up the timetable, it had me backing off pretty quickly, and I knew obviously today looked like it would be pretty nasty. We certainly got a hint of that in the Mideast markets overnight. Tell us the significance. Is it just a psychological significance? Is it a confidence significance? Or is there a financial significance too?
All of the above.
Okay.
And I think that what's important to keep in mind is that this is symptomatic of what the situation that we're in. We have kind of two things going on. You have, A, the reality. Okay, the mathematic reality of the macro situation that the global economy finds itself in. That's the reality. Then there's the perception of the reality, which until the last couple of weeks has been far different from what the underlying realities have been because of the ability of central banks to print money and keep stock markets, specifically stock markets, from doing exactly what they're doing now. So I think there's a reality check here, and what the downgrade of the U.S. credit rating means is that, hey, this is what's happening. We're now starting to see the reality. You strip away the wizard's he's behind the curtain and everything. You pull the curtain back, and guess what? It's the wizard throwing his switches. The underlying reality is that you have not done anything to address the real problems in the macroeconomy, specifically in the U.S., and then how that extends out to the globe.
It's funny. I heard President Obama today, and I'm not sure what I would expect, but my goodness, there was certainly no recognition of what this problem was. And I heard Timothy Geithner, the Treasury Secretary, and again, they're just in public denial, but I suspect it's more than that because they don't seem to get what you just alluded to here. It's
really mind-boggling to see the level of kind of surprise and shock and anger even that how dare they downgrade us? Well, guess what? You just threatened to default on your debt. You think that you deserve to be pristine in terms of the rating of what your credit risk is. The risk is what it is. And we just saw how close to the edge we can come in terms of having to deal with that risk. I think that to be surprised or, even angered by that is kind of ludicrous, frankly. Yeah, and that's what, I mean, to me, that also takes away some of the confidence I have in terms of their ability to deal with it, as if I should have any at this point. But literally, politicians throughout the world have not shown this ability to get the financial reality. Sometimes I think it's from a lack of sophistication in terms of economics and finance. Others, it's wishful thinking. Others, it's just political grandstanding. But I can't think of, Great Britain wasn't bad coming out of the gate in terms of making some changes there. They may not have been sufficient, but virtually every other case I can think of has not shown any grasp of the reality you described. Michael, it's decades. It's since we went off the gold standard. Decades of complacency. It's decades of, pulling the magic wand and waving the magic wand, printing money, and having everything be okay. And that has kind of run its course. If you want just one simple fact that's anecdotal yet glaring in how much it speaks volumes to that level of complacency, it is the fact that the U.S. Congress just crafts this deficit plan and then takes a 5-week paid vacation when they're supposed to be there working on the details of how they're going to address this problem. To me, that is glaring in the sense of they really just don't understand how serious this is because they've never been called to task like they are being called to task now. When that curtain is pulled back, the realities have become evident to everybody, and now we need to deal with those realities, and they're off taking a 5-week paid vacation.
Well, that's such a wonderful example, though, of what you're alluding to, is that they don't get the seriousness of this. We know in Europe they had to do the same thing as bring people back from vacation. Some wouldn't come, to discuss my goodness, and maybe you could address this just for a moment. If Italy goes or has, more severe problem, or if Spain does, they don't have the wherewithal to bail those countries out.
Well, amazingly, too, today's ECB announcement, European Central Bank announcement that they're going to buy the debt of Italy and Spain, and they come in and they bought some nominal amounts. We're not talking Greece. We're not talking Ireland or Portugal, where they, have basically bought roughly 74 billion euro worth of debt in this program, and they're sitting on their balance sheet now. The numbers for Spain, Italy, and Belgium, let's not forget Belgium, are staggering and huge. And to think that the ECB autonomously is going to be able to have the mechanisms to do this without having to sterilize it, in other words, drain that liquidity out somewhere as they add it without having to print new money, which is something the ECB does not do, I don't see how it's supposed to work. I just don't see it. So when you talk about their debt that matures, it's now. It's between now and the end of next year. It's an 18-month window that began the end of June where the numbers really start to stack up in terms of every month. Italy, the average, 35 billion euro every month. Spain, the average, 17 billion. Same with Belgium. These are big numbers. To think that the ECB is going to have the wherewithal, the political will, and the mechanism to buy the level of debt that's needed to be bought, they got a great bang for their buck today in the timing of their announcement, and it was something of a surprise. But now they got to follow through with action, and it's going to be much easier said than done.
I got to take a break. I'm talking with Greg Weldon. You can find him at www.weldon, WELDON, Weldon Online, Weldon Online. When I come back, I'll ask, Greg, to just paint a couple of scenarios, be a little bit of a futurist for us. How does this play out in the end, though? And are we seeing? Are we just grease in slow motion kind of thing at the stage we're at, especially if these other things? But the other point, just before I go, I want to make sure you understood what Greg was saying there, because he is the originator of bringing this to the public's attention, and that is we have a tendency to think governments have a deficit, and that means they have to borrow money to cover it. No, just as a bigger problem is that they have past borrowings coming due, as he just alluded to, 35 billion euro a month that Italy has to borrow, not for their deficit. No, it doesn't touch that. It's for stuff that was coming due, and all of this before the aging baby boom really starts costing their systems. That's why it's such a troublesome time at this point. Greg WellDone, my guest. More when you come back right here on the Big MW.
The World Today.
This is Gordon McDonald. Coming up on The World Today, we'll have some in-depth coverage.
It's a bad sign, by the way, when you continue to gain momentum to the downside. Every bit of buying was met by a wave of selling, but that also can mean that you sort of exhaust the selling at some point and you get a relief rally. Greg WellDone is with me right now, www.welldoneonline.com. He's the guy I say that other analysts read to figure out what the heck's going on with all the numbers. But Greg, because our time is so short here today, I want to just throw out a couple things at you. What advice are you giving investors in general at this point? Oh,
that we gave your listeners in June, which was, be with active managers that have flexibility, the ability to be short, CTA types. We run a CTA program here. Knock on wood, tomorrow's another day. We had a great day today because we're short stock indexes and more bonds and so on and so forth. So I think it's important to have that flexibility and to have that versatility and, to be able to deal with the opportunities that present themselves. For stock investors only that are caught long this market, that is just so tough because I think that the market has much more reality to deal with. The question becomes, how quickly does the Fed and other global central banks come back into play? My thought process is it's not going to be as quickly as it might have been, last March or in March of 2009, because you have some problems with thinking that, you can just print money and that's going to save stock markets when it also has a knock-on effect on commodities and how that impacts inflation in places like China. This is a great case in point where all of a sudden we're not as autonomous in our monetary policies in North America as we were in the past, where China and our sensitivity to these issues actually matters, where there's political pressure that can come to bear on the Fed from Asia that could actually make a difference in terms of the timing. Even worse than that is the potential for them, like I said before, to come with another program of saying we're going to buy treasuries, we're going to buy mortgages, we're going to try and peg the 10-year interest rate so we can bring mortgage rates down, and it doesn't work. It doesn't work to address the underlying macro problems. That could be a nightmare scenario. However,
sorry, go ahead, Greg.
I'm just going to say, however, they come with a big enough package. They print enough money. They could save the stock market. It presents a possible buying opportunity for, long-term investors. Though, again, the problem with that, though, is that this will lift everything, and it will cost more to buy a loaf of bread. It will cost more to buy a gallon of gas, and this will put pressure on the real economy, on consumers, so on and so forth. So it's a give and take. There's unintended consequences of whatever they do from here.
And the other thing is that, again, that's because there's no easy solutions, and I'm back in the political realm for a moment, but we keep getting suggestions that there were. I remember writing columns myself going back about 3 years and saying, you really think it's this easy? Yeah. And I look out on a series of problems like this, and I just wondered, when you look out, now I'm not talking the stock market, I'm just talking about practical society and government, what are some of the scenarios out there?
Well, you bring up just such a great point, Michael, because the time for academic solutions that could actually work is 20 years behind us. It was 1990-91 when they should not have done the things they did, especially then in 2000, 2001, dropping rates, monetizing debt, pushing out credit to the point where we can't pay it back. The thing to do would be let markets find their own natural levels and deal with the pain. The problem is you've come so far and reflated so many times and reflated so much that pain would be almost unbearable. And this is the situation they're in, and this is why they will choose to print as much as they have to try and, bail out and paper over this problem. The real fear, though, is, like I said before, that the problems are so, fundamental that merely printing more paper doesn't address the problems. It is the easiest solution to try and avoid the pain that we should have naturally felt throughout this entire cycle. The real academic answer is to feel the pain. The problem is, as human beings, we want to, it's pain aversion is our instinct. So that's the path they will take. The question then becomes, how do markets react to that? And you get back to gold. It brings you back to gold every time, because this is the main dynamic. They will ultimately print more money, and ultimately they will debase paper currencies by a greater degree, and ultimately that will continue to support gold to higher and higher levels.
And just very quickly in the last couple of minutes, and another dynamic of that is, of course, what goes on in China, which you spend a great deal of time analyzing. For Canadians, that whole prosperity-driven commodity push, where you had demand rises out of India and China and all those other cliches. I'm just wondering where that leads, because that's a central dynamic for Canada.
Yeah, and I mean, this is part of the problem for the Canadian dollar. And when we spoke in June, we had just kind of turned bearish on the Canadian dollar, and it's actually on the verge of breaking down right here. At par 70, on the futures contract for the Canadian dollar. Par 65 is kind of the breakdown low. You get down to 92, and how that might then impact the Canadian stock market, which is actually underperforming. It's outperforming to the downside on this dynamic, because it does, portend a demand side problem for commodities. And you see it in industrial metals, you see it in the energy complex, and so on and so forth. But at the same time, let's keep in mind, people are talking about, crude collapsing, quote unquote, collapsing to $50. Well, anytime before 2005, anytime in history, $50 would have been a record high. So these are kind of the things you got to keep in mind too, is what's relative. Where are we compared to where we were? We collapsed to 50. They print more money, and it goes back up and makes new highs. These are the kind of scenarios. The bottom line, Michael, if there's one thing that I could feel somewhat certain about, is that the volatility, the amplitude of volatility will continue to increase.
And again, that's what makes it such a difficult environment for pension fund managers. And I'm always reminding people when they hear stock market news, that's your pension fund they're talking about right now. Whether it's a Canada pension, the national pension, or whether it's individual pensions or what have you. And again, I'm looking again, these are big questions, but how much should I look to the last quarter of 08, first part of 09 to give sort of guidance of what might happen?
I think there's good guidance to be gleaned from that, depending, of course, what the wild card is in central banking terms. Mm-hmm. But I think, you went into a primary bear market beginning in 07, and if that is the case, in many markets, this doesn't necessarily apply to the U.S., but in many, many markets, the rally since the low in 09, the last quarter of 08 and the beginning of 09, has met Fibonacci retracements. That's a 50% rally relative to the loss, which means that this is the second leg down in a primary bear market, which makes it, not to get too technical, but if you're, wave one was 07 to 09, wave two was your 50% retracement. This is wave three, which is supposed to be the most, the most violent wave. That doesn't bode well, for equities and commodities, potentially testing, if not worse, the 08, 09 lows.
Fascinating stuff, Greg. I really appreciate you finding time for us today. A very busy day for you, but much appreciated.
My pleasure, Michael.
WellDone